I've been often asked why I don't cover macro in the podcast because there are so many popular macro podcasts. And the reason is simple. I cover investment management, not investing. So it's not about getting investment ideas, it's about gathering investment management intelligence. Yet macro matters enormously. And therefore, what I want to try to understand is how it works and how do you separate the macro that you use as a sophisticated long-term investor to the macro news and noise that we are covered with. And that's why I'm so grateful to have the opportunity to talk to Dylan Smith, a chief economist for private markets and the founder of ARC Macro. Dylan, welcome to the show.
Thanks, George. It's really good to be here.
So I feel like I know what macro is. I probably put economic data, political events, maybe the weather, maybe more things into it, but I think we need to start with a definition. How would you define it?
Yeah, it's not actually that straightforward to define. The way that I like to think about it is anything that is outside of your direct control, that is not a decision made by someone else necessarily, but that will affect investment performance and affect investment returns, right? So we're not talking about regulations, but we're talking about the stuff that is way outside of your ability to control within a portfolio, within the management of the company, but which is going to have an impact on the bottom line. And as you say, generally we tend to think of that in terms of the classic data points like GDP or inflation or interest rates. And of course it encompasses that, but I think it's a little bigger too. It's this idea of a large set of interconnected events that influence each other and influence markets and ultimately influence your investments.
Right, so it's a broader definition that I had anticipated, but actually makes perfect sense because sometimes, and we're going to get back to that, but sometimes I feel there's a lot of macro happening these days. There's a war and stuff like that. So I know you got some views on that. But before we get into this, I want to ask, that's also your product, right? You're selling macro to institutional investors. What is it exactly you're selling? Is it like a forecast or a guide, or is it more like a framework? How do you see them using it?
I think the best way to describe it is we're selling advice that helps investors navigate this big macro environment that we talked about just now. It is framework-based what we do. So we have a certain way, not of thinking about the world so much as thinking about how to think about the world. And we can get into that a little bit more. And so there's a lot of data behind that. There's some modeling, genuine expertise. But I think what we do a little differently to what already exists is we like to get close to our clients, right? So we're not writing a table with GDP forecasts and sending it to Bloomberg and being one of the 50 people in Bloomberg with a forecast. We're trying to help people think a lot more structurally about how the macro picture affects their specific portfolio, right? And so it's a mix of research and consulting, but we're one level closer to our clients. We understand their priorities, their investments, their portfolio. We can tailor what we're doing and tailor our frameworks and approach to actually drive decision-making at these places. So we're really trying to connect that. We understand the macro picture, but we're not going to leave you alone in terms of how to work out how that actually affects you, which I think is often a huge gap, right? It's not hard to find sell-side analysis. It's quite difficult to make the connection between that and the investment and the investing strategy. So we're bringing the macro one step closer for people who don't have it in-house already.
Right. And also your approach, so we can go to the specifics of the clients, but you also have an industry-specific approach, which is private market, which is unusual. And I hadn't had in my mind that you necessarily had a different approach. So perhaps you can tell us about that, Joyce.
Yeah, so I think the other thing that we're trying to think very hard about is as the investment landscape changes, we've moved away from this idea where most portfolios don't have some kind of private exposure. And that's happening at the same time, we argue, that the private markets industry is maturing and scaling to a point where macro actually really does matter for performance and for how private markets interact with the rest of the financial system. So how their relationships work with LPs, with companies, with regulators, with the broader system, right? So we think both sides need to be a bit more aware and clued into each other in terms of how the macro drives that. And so what that requires from the Economist is a bit of a shift in how you think, right? So you're not just worried about next week's CPI print if you have in mind private market performance, because that's illiquid, it's long-term, and returns are driven by slightly different things, although they are affected by macro. And so we've re-looked at the economics toolkit. We've kept most of it, but we've shifted the focus to say, okay, we've got to be a lot more long-term. We've got to be a lot more structural. And so there's a horizon question that comes into play there. We're not thinking about what's happening next week or next month. We're thinking about what's happening in a year, 2 years, 3 years, and how the information that we know now is going to affect returns way down the line. Now, obviously, the further ahead you go, the less certain you get. And so our primary framework is basically scenario-based, right? But it's not just sticking our fingers in the air and saying, oh, there's a whole universe of things that could happen. It's based on understanding that events now do chain into the future and they can branch away, but we can assign pretty good probabilities around that by mixing some fairly sophisticated modeling and data, and models can't capture everything, and so some expertise as well, to have a kind of quantitative data-driven way of making scenarios that help people to plan over medium-term timelines and to make decisions now. You also said that we go a bit more granular. That's another important part of what we do. Private markets tend to operate in verticals, and those verticals can get quite refined. The way that macro affects verticals is very different. So if you have an inflationary scenario, particularly industries are going to be much more or less appealing than if your scenario is non-inflationary, just to make a very simple example. And so we dig right down into a pretty refined industry level and say, okay, if you're thinking through inflation, how does this industry typically work under that scenario? Is this an inflation-protected industry? Do revenues rise faster than costs? How do labor markets interact, etc.? And with clients who we have a relationship with, we might go even deeper on that and look at specific names or specific benchmarks.
There's potentially the whole universe of macro, which varies in terms of everything: geographies, industries, time horizon. And then there's the application that obviously you've identified that perhaps was missing, which is more focused and, in fact, pretty much can be tailored to a specific portfolio need. Let's dig straight into that, because I'm quite interested in this scenario approach. And I've been reading your latest Outlook, and you introduced those scenarios. So there's 3 cases, 40% for supply shock sorted, and obviously we're talking about, we're recording this in the 20th of May. There's major geopolitical events happening in Iran. Scenario 2, stagflation, 30%. Scenario 3, rapid resolution, 30%. Perhaps we can first start by, okay, what do I do with that? As I've got my probability and different paths to this. Because it's not always clear to me, like, okay, I've got to...
Because scenarios now what? Yeah. So this is the key thing. The first thing this does is it outlines and helps you wait and think through what might actually happen. I think...
Right, because I might think like there's an infinite universe of possibilities.
Yeah.
And there is, but somehow if we think of it through... Yeah.
There's kind of 2 biases that happen, I think. So one is that you'll sometimes hear people saying, oh, this is so unpredictable, it's so chaotic, I'm actually just going to ignore it. My best response here to the level of chaos and unpredictability is to ignore this completely and continue as I was. And we hear that quite a lot, especially in private markets. Is that you're dealing with is, oh, I know what's going to happen. Trump's going to chicken out. 100% confident on that. And
Sure.
And I can build my case on that. I do that quite a lot as well, especially in the retail market. This tries to draw a bit of a middle ground to that and say, like, sure, there are a lot of possible outcomes, but the number of outcomes that actually fundamentally change how you might think through a portfolio is actually quite small, right? In all these scenarios, you can have small gradations of difference, but fundamentally, you're thinking of 3 very different paths for interest rate, very different paths for inflation, very different paths for growth, that are still plausible at this point as we think through how this shock is going to propagate through the economy. And it gives you a sense of what's more or less likely. Now, the important thing is to think through, you can have different risk management approaches to your portfolio based on those scenarios. But the important thing is that you have good quality of information coming in. And actually, there's something really interesting going on in central banks at the moment, because they're essentially trying to do the same thing, right? They're trying to think through, do we look through pieces of information here? And you pull up the Bank of England arguing, actually, what you want to do is take these scenarios and work out what is the most conservative response that kind of protects the economy the most, right? And you could map that type of thinking onto portfolio as well, depending on your risk tolerance. You could say, okay, across these scenarios, there's things that are clearly not happening, right? So maybe we can say, okay, that's where we'd want to try and diversify our risk into something like that. Or you might say the small probability but highly adverse scenario for our portfolio is important enough that we might want to de-risk certain bits of our portfolio. Or you might want to say, all three scenarios, there's a fair amount of inflation coming. It differs in how long it lasts, but we can build an investment case around that either way. And so that's how you interpret it depends a lot on your risk tolerance. And this is why we like to be close to clients, because we can help them interpret that a bit better. Depends what your starting portfolio is, what your mandate is, what your risk tolerance is. But it gives you a path to start navigating things, I think, and that's important.
Yes. You mentioned that it's also about the bias that we have and helping overcome this. And we know that every investor, most professional one, perhaps has mitigated those biases, but we all have them, and it's very easy to be overwhelmed for the flow of information. So is it a little bit that as well? You're not just adding to the information we have, but pulling it back and giving people like, this is what this scenario is, this probability is. It's a way to see the world, to still get all the information, but put numbers to it and assign like risk and then actions.
I think that's right. Yeah, we're trying to preserve the good things about economics and forecasting, which is, working from the data, having good models to help us interpret that data. But we're trying not to arrive at one view of the world where you have to have your bearish economist on call and your bullish economist on call and then try and triangulate between them and map it over your own biases. The starting point is fundamentally to say there is uncertainty, but it's not a uniform distribution. It's an uncertainty that piles up probability more in different places. And if we understand that well, then we actually can respond to it.
We talked about private markets. This is your focus. Can you tell us, like, specifically, who are your users, readers? Is it the chief investment officer or whoever is like strictly in the investment side of things? Or should everyone pay attention to it?
Yeah, so that's an interesting one. As we built the business, and you've almost put your finger on it already, we've realized that our core client, our sort of ideal client profile is really a CIO. So as we've had conversations and worked with different people in different types of organizations, we've realized that the value really is for people who are looking across a portfolio, and especially people who are looking across a portfolio with different liquidity profiles in different parts of the portfolio. So the kind of absolute core client is some kind of LP or institutional investor, which has a chunky piece of private exposure, private market exposure and investment, is thinking through how that interacts, but then also some significant liquid investments. And the reason I think goes back to what we were talking about just now is that liquid part is your margin for adjustment. It's actually how you offset and balance off risk against the illiquid part of the portfolio, which is being affected by these macro forces, but which you can't easily shift direction on or change direction on, right? Our most natural client base and the clients I think we provide the most value to and we have the deepest relationships that are advisory and consulting is with family offices, it's with pension funds, it's with endowments and those types of businesses which are trying to think through this constellation of risk that runs across a portfolio with different timelines on it and different levels of liquidity. It's not our only client base, so we also sell just straight research into more traditional users of macro research who still find both our framework and our models and our IP valuable inputs into what they do. So there's some hedge funds and commodity trading funds and more traditional macro consumers. And then also we found, quite interestingly, we're getting a lot of interest from the kind of services industry around private markets, right? So people who need to be informed, people who are talking a lot to private investors, maybe of smaller, more mid-market funds, who probably are too deeply focused on what they do on the micro level to really bring on full macro advice, but where they need that bigger context. So that's law firms and consulting firms and places like that find a lot of our modeling useful, especially we now cast deal flow and distributions and sort of private market specific stuff like that, which they find very helpful. So yeah, we're trying to service the whole industry, but I think the core is the CIO of the firm that is driving capital allocation decisions across a portfolio that includes illiquid investments.
Right. And so this is interesting because indeed it's where the market seems to be going. Every private market seems to be integrated a lot more into a broader sense of portfolios. And therefore, how do you deal with them? And it's an interesting approach because it's not just very often you think about buckets that maybe separate, but integrated. And it's an obvious statement, but it's not that easy because you speak, we're going to increase, decrease the private side or things like that. But what you're saying is that with the macro, you can look at it as a portfolio, and as you've committed in a different way to the privates because it's something that you're going to be in there for the long time, then you're looking at what you can adjust. And it could be, you said like it could be very vibrant, but from what I gather, it could almost be like other instruments. I'm thinking of derivatives because I'm thinking of hedging, that I might use this liquid derivative instrument to hedge or to anticipate something, this 30% scenario on the private market side of things, which I hold strategically. Is that something like that makes sense, this whole mix?
Yeah, that's exactly right. So part of it is having the ability to make that kind of response. And I think maybe to make that concrete, everyone was going into the year expecting deal flow in private equity to really start picking up again, right? We have this very conducive environment to deal making with interest rates having come down, and beginning of the year, we're expecting a couple more cuts, plus a sort of hands-off regulatory approach that was going to allow more M&A to happen. And so if you are an LP and you've been holding off on making new investments in private markets until you get your distributions back, that pickup in deal flow is good because after the deal flow comes distributions and there's exits, and the market falls a little bit from where we're seeing it. But the macro picture has shifted since then significantly. I think that resumption is on pause for a while. We're going to see interest rates going up. We're going to see a more difficult deal environment. And we're going to see, again, firms struggle to distribute the way that they wanted to. And so I think that's just a real example of a macro event flowing through directly into how you do your cash flow modeling, right, as an investment firm. The other thing that we're offering actually is, I think, a little more sophisticated than that, and it's not necessarily about the adjustment margin, but which is to understand that underlying macro risk exposure can be highly correlated across a portfolio in ways that I think are fairly underappreciated. If you think through inflation and higher interest rates tends to have quite a big effect on industries like software, which tend to be highly leveraged. Now, private markets are way in software proportionally compared to the economy and compared to the makeup of public markets, actually. But equally, we know that there's a concentration problem on the S&P 500 where tech and software are actually driving almost all the moves in aggregate indices, right? So there is you might think your exposure to rates is a certain amount based on looking at your fixed income portfolio, but actually it's enormously impactful across both public and private. And we've got the tools and data and models to quantify that and tell you how much and how correlated you are to underlying macro exposures. So there's a kind of factor framework at play there that we like to do, but the difference is we can do it on privates as well. And so you can both understand your true risk exposure, your underlying risk exposure to macro, but then also we found that's obviously most useful for people who can adjust in response to that, which is why we're talking about these mixed portfolios.
Yeah. Okay, let's go a bit behind the scene on how does that work, right? You mentioned your models, you mentioned and I can see what the output is, and they're very different publications and mentioned through your format. But so how does it, so what I see from your publication is articles of different lengths, of different frequencies. But what goes on behind the scene? Is it data-driven? Do you have big models running back, or is it a lot of thinking?
I guess the value is in providing a combination of both. What most of the public will see, we do put some kind of free stuff out, basically just to give you a sense of what we're doing and how we approach. So there's a Substack that's just me refining and publishing some old stuff that we've sent to clients or making a few observations and charts just to say this and that is happening. But really the core work is in what we're sending to clients. And there, as you said, there's quite a spectrum, basically depending on how deep we're going. So there's kind of standard research that we put out, which essentially gives clients access to all our data and models, effective framework for tracking the economy, all the different betas by industry, and our costs we were talking about for private markets. You get basically access to all that, and a weekly note. And in that weekly note, it's a mix of traditional sell-side stuff where we publish a little research piece on something topical, but really we're folding that all into our framework and our way of seeing the world. So it's also an opportunity to adjust probabilities around scenarios if we need to, or we might dig in and say, okay, models are starting to flag that things are looking more stagflationary than we thought in our kind of outlook report. It's just a way we think weekly is like the absolute most frequent horizon you do need to look at macro. It's tempting to look at it more regularly, and I guess if short-term quant trader, you're in a different world. But that's basically for clients who don't want to have to spend time following the news and following developments. It's a quick way to say, here's what actually matters. Here's a signal this week. Here's how it affects how we think about the world. And here's a little piece of research which kind of digs deeper into one of these things which you think is important. And then, so anyone who we have a relationship with basically gets that research. And then the core of the business is to say, okay, it's working with the companies we have on retainer or consulting relationships with and feeding through into their requirements, essentially. So whether that's specific bits of research that they need because there's some decision coming up, whether it's monitoring that's more tailored to their portfolio, whether it's just being on hand for a call to discuss some kind of development and how we see the world.
So I understand it depends on the size of the client, etc. But what is it you do that they cannot do easily? And is it that you have more data feed? Is it that you have bigger models? Is it that you have your framework and your experience as an economist? I guess the answer is in the question, but yeah, can you be more specific about that?
Yeah, I think it's all of those things. So it's a huge amount of dealing with the data. So wrangling it, interpreting it, working out the right types of models to look at the right types of data. A huge amount of time actually is spent then packaging and communicating that in a way that people will understand. Simply, it's tempting to do some like good work, some sophisticated modeling, and then try and explain to a busy CIO what you've done and their eyes glaze over and whatever. Actually, what we need to do is bring them, here's what we think, here's why we think it, here's why it matters for you, right? So there's a lot of time actually spent in that translation component. But yeah, it's working with traditional kind of economist skills and bringing that to them. And I think we're doing it for people who don't want to bring someone in full time, basically. And so it's fractionalized or shared across. It gives us an ability to have our fingers in a lot of different pies, to receive lots of feedback from different places and offer it back to our clients. But we could be brought in-house. You could build a team that does what Arc Macro does. But in many cases, we're working with institutions of the size where that's not actually, there's better ways to spend money, and you can get all of that without having someone on full time.
Got it. And now I also want to try to, now that I've said that we don't cover macro events and day to day, I still have things that puzzle me about the current situation.
Yeah.
There seems to be, so my naive perhaps interpretation, there's a lot of macro happening because there's a war, and therefore there's a petrol, and therefore there's a rate, and this and that. First of all, the macro hedge funds, where you think, like, oh, this is when they're going to thrive, had a terrible time. So you think like, oh, guys, this is when we need you. This is like when we want something that correlates.
This is still within our remit to advise on the macro landscape. I think not all hedge funds did badly, right? There were some who were well positioned. There were some who actually traded the breakdown in correlations kind of correctly and kind of did their job.
But overall, what I've seen is that they struggled when you did the.
Yeah, no, I think that's right. So, but I think that comes down to what I was saying. If you look at why they did so badly, it was because they had enormous macro bets on going into the year that didn't account for one large kind of shock event that so drastically shifted the landscape. I think we can get into that. I think it's kind of interesting how it relates to how we were seeing the world at that point, which was basically that bet that hedge funds were kind of had made before going into the war, I think was what we would call our baseline scenario, right? So it was inflation sort of staying stable or continuing to moderate down. This big AI capex cycle happening in the US, supercharged by tax rebates, really starting to create a really nice kind of macro picture, which hedge funds are starting to trade. And that was our baseline scenario, but it wasn't actually like overwhelmingly high likely. We had it around 50%. And another scenario we had, which we assigned, I think, out of consensus high odds, was a high inflation environment in which both growth and inflation were quite strong, right? And we were seeing what was happening in kind of price setting behavior amongst firms. We were seeing what was happening with delayed tariff pass-through that was still coming. We were seeing AI build out as basically inflationary. We thought US labor markets looked quite inflationary. And so we were feeding back to that industry, like, guys, it's not as good as you think. Now, we didn't anticipate an invasion in Iran, but there was also some geopolitical uncertainty built into that to say if you have some kind of event geopolitically, we thought it might actually be more tension with China and a rise in prices. It's going to hit an already inflationary kind of landscape here where we're struggling to get inflation down to target. And we got to keep that in mind. And that was a 25% scenario, right? So we got the kind of the shock wrong or the activated shock wrong. But this is why we tend to prefer to work with investors who aren't making one big bet all the time, right? We're trying to work with people who are navigating an uncertain outlook. And I think if you had that in mind and had that in mind when you were positioning, you might have thought that through a little differently.
This is where the probabilities come in as well, right? Because I'm not saying this path, I'm saying a world where there's many different paths with probabilities. Therefore, I can take bets with positioning, with hedge, or maybe with an exit strategy or something like that. This is what it's about, and I guess that also comes to the fact that people who are investing in private markets are, or should, because that's another story, have a longer term perspective. Oh, there's my baseline, and then there's this potential inflation shock. Oh, okay, this is always a probability, and that's how I figure out the world, right?
But you know what's interesting there? Both of those scenarios, you're fine to stay in equities.
Yes, indeed, yes.
So that's where it gets nuanced. It's not like you're saying different ways the world can evolve, and each one has like drastically different consequences for how you invest. There'll be commonalities where you can manage risk across those things.
Right. So we're looking at this macro for sophisticated investor and longer term, etc., which I think now I'm getting a clear picture. I just want to touch upon this thing for perhaps less sophisticated investors. We all have sometimes sophisticated and sometimes less. I like this Dunning-Kruger effect, where, when you fit, you understand something, that's where you're the most confident and likely to do the most stupid things. And I think there's a bit of that risk, and perhaps it goes back to the bias that you're talking about, right? Whereas we obviously flooded with news, and they are a macro signal. It's easy to act upon that with shallow knowledge. So is that also a little bit the way you could think of it? So that the news are also this shallow macro environment that is dangerous because this, I'll put in the screen this Dunning-Kruger effect, which people might be familiar with, which you do the most stupid things not when you know nothing, but when you do know enough to feel confident.
I think that's completely right. And to your point, I think it is more prevalent in the retail community,
Sure.
where people might have certain prior expertise, but it's often not in macro. And the challenge there, I think, for retail investors is the news flow gives you an incredibly strong macro narrative all the time. Like if you switch on CNBC or Bloomberg, like you really get, because they're churning content they have to talk all day, you just get this sort of one-sided consensus view, and it's always extremely fragile. It changes so quickly. And so there's a sense of whiplash often. But people don't realize they're trading these like rapidly shifting macro narratives that go back and forth. I found certainly in institutional contexts, that's not as much of a problem. I think people respect the macro more. The problem is they don't always know what to do about it. And
I was going to ask about that actually, because how does it work? Because I guess people always take somehow macro consideration, but do you at some point say, okay, I want to have a more integrated approach with my macro, or I want to reflect on my process, or is it something that people have done forever, but perhaps it can be done in a more structured way? How is that part of the broader investment decision process?
I think we are starting to see that. I think there's, especially in the smaller funds like family offices or things like that, where it might have been done quite informally. There's an explicit kind of macro lens that we're starting to provide on those portfolios. In many cases, we'll come in and we'll quantify underlying exposures and give the macro view on the scenario based, and basically people are comfortable with the better understanding that they have and are comfortable with outlining their explicit investment philosophy more because they now understand this, right? So if we go back to that example we were talking about, maybe you're actually way more software focused than you thought, and your underlying rate or inflation exposure is way higher than you initially thought. Sometimes the conversation goes around that for a while, and people say, actually, we're fine with that. Like, that's a risk we're willing to take on. Or sometimes it leads to conversations that say, okay, but we're going to start moving the portfolio a bit differently in this direction or that direction. So yeah, we're definitely seeing that. I think back to the Dunning-Kruger effect, the nature of markets mean that, pretty quickly you'll learn that you're a victim, right? If you go into sort of that type of trading strategy, because they're going to play the macro, you're going to end up like those hedge funds pretty quickly. And so I think there's a disciplining mechanism in the market which prevents people from doing it for too long.
Right. And as we need to move on, there wouldn't be a podcast about investment manager without talking about AI. And I guess that comes into play because I think there's a temptation to solve the macro, in particular with AI. And I think this is something that we discussed a little bit in terms of the process of the industry. So I'd be very keen to have your view on that.
Yeah, so our basic philosophy to AI is that it's very useful, but the closer we get to the client, the less AI there is in what we do. And I think that's a principle you can actually have inside a fund as well, is to say the closer we get to decisions, the less AI there is. So we make extensive use of AI. It's an amazing tool. It is only that, it's a tool. It's not an expert, it's not an opinion. And we're using it in the way that it's designed to be used, which is it makes coding incredibly fast and much higher quality. We have a line-by-line review process on any code that it produces because very small errors can lead to large model errors, even if you can't pick it up in the final result. But it speeds us up. It's also very useful for rowing and collecting information. So I think in my view, the days of the kind of daily, this data went up, this data went down type of macro coverage, that's going to get killed by AI, I think. And it's shit because it's often people are just reporting the wiggles and slightly volatile series, right? And so that's why we've taken a step back from that kind of work. If you want it, AI is going to do it. It's going to do it pretty well. But you need this kind of big picture. So as we get closer and closer to the client, we use these AI tools to feed our machine, to help build the machine, the interpretation part of that, and the expert input part of that, and the working out what's important and what's not is very important. And I think it's worth always keeping in mind, AI is about averages, and it's backward looking. It produces the next most likely token based on its understanding of all the past information, right? So if you're trying to think about scenarios, what might happen in the future, and what's important about the differences and inflection points, does the thing that happened, like, is this a meaningful shift in the kind of structure of the economy? That's far too sophisticated for AI to answer. It will give you an answer, and it will sound confident about it. But there's a huge amount of risk in that. And if you already have certain biases, or you're low down on the Dunning-Kruger scale, or you're not great at macro, but you get this kind of answer, it's very tempting to treat that as the truth and act on.
Yeah, that goes back again to helping ourselves with our biases, which eventually is one of the really most important, most strategic thing as investors of all types. And talking a bit about AI and content, etc., there's also one thing from your research that I'm very interested in, is how you package it. And I can see there's different sort of formats. There's residuals, trajectories, projection, which all correspond to something. Some miss the memo as well, different things. But I'm wondering how important is this? So those are perhaps terms as style and visuals and things like that for you and your client. How do you think about that?
Part of it is just traditional kind of branding and helping stay top of mind and give clients a certain experience of working with you that's good and pleasant and consistent. So I think that stuff can be important. It can be important, especially around the kind of, we're professionals. We want to communicate that we're professionals. I think there's a lot of information and analysis out there, especially when you start entering the sort of Substack world or blog world. But a lot of it, I think, tonally is quite extreme. And so we're trying to communicate the type of services we're offering, which is sober analysis. We're pleasant to deal with, but we're not going to be snarky analysts kind of thing. Right? I think in the way you set up your tone and the way you set up your brand and visuals, that's all very important. And then part of it is just there's product differentiation. Things get their names and they get bucketed and pulled according to what investors need. So there's the completely public-facing stuff that's just a kind of introduction to what we do that goes out for free. And then everything with inside the kind of paywall or relationship with us, depending on what you need, is you're going to get different pieces of it. So some people just take the weekly research and the access to data, and that's all they need, and that's great. Other people need slightly deeper things, and we provide that too.
And you mentioned it can go very close to the client, and therefore linking to the micro of their companies. Perhaps we can talk a little bit more about that, because what could it be an example? You talk about an LP perspective, right? So would they be considering at micro level, would they be considered the specific companies that their fund is investing in? So this fund is invested in this company. Okay, all right. But would you say at company level, or is it at sector level, like you said, software?
Yeah, so we don't give investment advice, right? So we'll never say buy this or buy that, or don't buy this, don't buy that. We'll do it at the general portfolio level. We'll identify risk, we'll identify opportunities, we'll profile industries. We tend to keep it on the industry level, but occasionally exposures are kind of niche or bucketed in such a way that we'd maybe do something like build a public comp system for private markets. You spoke about Dunning-Kruger and expertise. We're not individual stock analysts. It's not the service we provide. There are people who do that very well. So we know what our role is within these organizations, which is to translate all that big picture stuff down into something that is granular enough that when you're assessing a specific investment, you have that information that you need.
Gotcha. And finally, what's an opinion commonly held in the industry that you disagree with?
Yeah, one thing that kind of is on my mind quite a lot is, and especially now with how every time someone meets me for the first time is, oh, you're an economist, what a great time to be an economist. Like, there's so much chaos in the world. And really, that's been true basically my entire career, right? It was GFC, it was Brexit and all the chaos in Europe, it was COVID. Like, it's never not been true. But people tend to view often macro developments almost as entirely political. And I think partly that's the news media's fault because that's their natural lens as they report. But I think people aren't sophisticated enough at separating fundamental kind of macro-driven cyclical and structural processes from what the politicians are doing. And you get this bleed over where you're trying to attribute all this macro stuff often to policy and to presidential decisions and presidential priorities, what have you, when actually often those are responding to a macro situation that already exists, which is not to say a politician can't change the world very quickly. They can. They can invade a country, for instance, as we're seeing, or decide to put a blockade in place or whatever. So it does matter. But I would separate those like big kind of risk events that politicians can drive from the general equilibrium flow that the economy tends to be in, of which policy is just one input. And a huge number of factors are driving that all the time. So that's one thing I'd say is we need to step away from a little bit. And the more you do that, I think the more balanced of an outlook you can develop.
Right, because I think that's exactly what we're trying to do collectively with the example of war in Iran. We're trying to say, oh, it is, is it solved, is it not solved? And there's going to be a declaration and it's going to say it's solved or not solved. So, and this seems to have, though, a huge impact, right? But you're saying that we should understand this as part of a broader cycle? Or it's just bigger waves or cycles?
Yeah, look, I think these types of very big things where, there's a very clear political decision to make, which will affect things. I think that's...
Yeah, which can be binary, but eventually
exactly.
we realize that the outcome is not binary. It's not open or closed.
Exactly. Yeah, but outside of that, I think we do tend to over-attribute. Here's an example, right? For a long time, we've been thinking very hard about inflation. We've known that inflation is a big problem. It's driven interest rate policy at the Fed. It's driven markets to a degree. But actually, I think inflation has decided political developments more than politicians have decided what inflation is, if that makes sense. And their ability to actually control it has been extremely limited. I think we've seen Trump already give up and acknowledge the limits of his actions. He tried at the beginning of the year to say, I'm taking on affordability, and made two weird little policies about mortgage interest rates and private equity buying homes, and has since completely given up on that, right? And I think he's given up because he's realized how hard of a problem it is, how structural it is, how long-term the forces operating are, and really we'll be dealing with whatever Trump's legacy is on inflation probably when he's out of office. And it's often true that we're living in the world of the prior administrations because of how slowly these things operate and how many other factors are involved.
Right. So if I apply this to understand a macro, it seems like what we see as macroeconomic news, macroeconomic developments on a day-to-day basis, they're
often noise.
And they probably not help. They hinder us from the true understanding of macro in a way that will have a meaningful impact or manageable impact on our portfolio.
Yeah, and the skill is in interpreting which among that big haystack of mostly noise, which of the decisions and the events that actually do matter will shift a landscape which otherwise would probably have evolved pretty similarly without those decisions being made.
Right. And also probably, so the shifting the landscape and also understanding the broader cycle and things like that which will eventually, we have the imaginary little cycle over a win. That's what's going to be the main driver, right?
That's right.
So that's really, I think, a good conclusion as we were aiming in this episode to understand why macro, how to use it. And obviously you've been talking about macro for prior markets, but I think there's a very big lessons here in general for investors, which has to do with noise, biases, and things like that. It could be also, you need to make your own macro. You need to figure out the macro that worked for you, but obviously it's better left for professionals because there is this Dunning-Kruger effect that may affect all of us. All right, I don't know if that's a good conclusion. Do you have anything else to add, Dylan?
Great conclusion. Conclusion.
All
Thanks,
right.
John.
I'm very grateful. Dylan, can you just tell us where people can keep in touch, contact you, follow your work?
Of course. If they go to arcmacro.com, everything's essentially there. They'll find a link to the Substack if they want to follow along, and also all the different ways to get in touch with us. The usual platforms as well, LinkedIn, places like that. Content will come up. Feel free to drop me a note there as well.
Wonderful. We'll link those up as well in the description of the podcast. Thank you all for listening. Until next time.